Hey guys, welcome back to another episode of Market Champions. Today we've got Billy Duberstein from Stone Oak Capital. He is, I believe, the managing member at Stone Oak Capital as well as the founder. And Stone Oak Capital has some incredible returns. So let me just find that here. So Stone Oak Capital is up 116% since inception compared to under 100%, just under 100% for the S&P. So that's incredible. So I'm really happy to have you here.
Thanks very much, Sri. Trying our best.
So could you give us a bit of your background and how you got into finance and your journey to Wall Street today?
Sure. Well, I wouldn't say I'm on Wall Street.
I'm sure you're in LA.
I would say I have very much of an outsider background. Even though I grew up in the New York area, I grew up in a family that, my dad and our family made most of our income when I was growing up from investments, and my dad was an entrepreneur and a lawyer by training. So a lot of principles of investing were, I guess, instilled in me from a young age. But by the time I got to college, I gravitated away from it. I was much more liberal arts. I was a music major. Just out of college, I took a stab at being a screenwriter and filmmaker. So I definitely didn't take the normal path to being an investor. Of course, in college, I took accounting and economics and was pretty well-rounded. But I guess shortly into my professional career, I became obsessed with investing. Like you're probably ahead of the game in terms of where I was. Really, as an adult, when I started managing my own finances and started managing my own investments, got the bug pretty early. I started reading investment books because I wanted to get good at it, and I was just intellectually curious about it. And I think the first thing I read was Robert Hagstrom's Investing: The Last Liberal Art, which appealed to me because I was a nerd. I was very into basically every single subject at school. I was one of those weird people who liked learning about pretty much anything. Math, politics, economics, literature, science. And so what I really loved about investing is how you sort of bring all of those disciplines into what you're doing. And I guess from there I got pretty hooked. I then decided to read all of the Warren Buffett shareholder letters going back to, I think, 1976 or 1977 is when they started. And that's like a novel. And then getting into his influences, Benjamin Graham, Phil Fisher, and then Peter Lynch. And I started pretty seriously investing on my own. I guess you could say I was a bit self-taught. And then eventually decided to go to business school late in my 20s. I went to NYU and I studied under some great professors there.
Did you get to meet Ashwat Damodaran?
Ashwat Damodaran, I took both of his classes, corporate finance and valuation.
There we go.
And that definitely instilled the quantitative discipline, valuation discipline that we bring in here at Stone Oak on top of sort of the qualitative origins, I guess you could say. And coming out of school, active investment management is kind of in a strange place right now. It's in a little bit of flux. And when I was in school, I started managing my own concentrated value portfolio that eventually became Stone Oak, and started posting ideas to a website called SumZero, which was a platform where employers and, just to get exposure. And my last year.
You're on Seeking Alpha as well, so that's you, right?
I was, yes, not anymore, but yes, I have written for Seeking Alpha, not recently. I do write some for the Motley Fool, so you can find me there. But on SumZero is more of a very professional platform. There's funds on there. There's allocators on there. And I wound up being in the top 5. You know, my first 2 ideas kind of hit it out of the park. I got a little lucky. And
Which one was it?
what's that?
Do you mind telling us what stock it was that you hit out of the park?
Yeah, well, it was 2 ideas. First was Ubiquity Networks, which I first invested in 2015 and still own shares today. It's up almost 10x since then. Wow. That could be my best investment I've ever made. Certainly one of them. Then there was another distressed, and the other one was more of a distressed value situation. Oh gosh, it doesn't exist anymore. It was a solar yield co. Sun Edison went bankrupt, but it had these 2 yield cos that were like affiliated with it. And one of them went down sort of in conjunction with, it was a very complicated story. I probably don't have time to get into. It was a distressed solar company though that wound up bouncing back pretty strong.
So what was it that caused you like, did you ever have like an aha moment when you decided to move from, say, music and film to, you know, going and getting an MBA? Because those are like 2 completely opposite things to do.
Right. It was an evolution. I came to the conclusion that I really enjoyed the day in, day out activities of researching investment ideas, and it more suited I have a very analytical personality by nature, not so much wanting to open up some of the emotional opening up that's required in dramatic screenwriting, and just eventually I just realized the day-to-day, and you know, there's, in terms of making in the entertainment business, it's not exactly, it's a little bit of a crapshoot. It's not exactly a meritocracy. What I liked about investing is that, you know, if you're right over the long run,
you'll make money.
You'll make money.
Right.
So it's more of a meritocracy that way. And I enjoy like reading and analyzing about the world more than I liked, you know, inventing fictional characters, I guess. But I do think the storytelling training that, you know, going through the storytelling training helps with some of the qualitative parts of investing that might differentiate Stone Oak's approach a little bit more than someone who did, you know, accounting, economics, 2 years of investment banking, and then going into, and then going straight into investing. So I think that differentiates us a little bit. And we really look at the story behind the stock, and we look at it from maybe more angles than someone from more of a straight quantitative perspective. And I think that it's helpful.
So what exactly got you into tech? I mean, if you watch all the Warren Buffett interviews, you know, he's probably, for the most part, he's pretty much against tech until like sort of the last decade when he opened a big position in Apple. But, you know, what exactly drew you to tech?
Few different things. Well, first, you know, there's a old story about a bank robber named Willie Sutton, and he was caught by the police, and they asked, you know, Mr. Sutton, why do you rob banks? And he goes, because that's where the money is. So I feel that's sort of the same way about the technology sector today. You know, even though I grew up on Buffett principles, I also love what's new and what's on the cutting edge of technology and what's exciting. And I would say Warren Buffett is very conservative about what he feels confident in, but, you know, I'm a little younger. I got more time ahead of me. Hopefully Buffett lives a long time, but if you start reading about something you're interested in and you go to bed a little bit smarter every day than you woke up, eventually you'll have a pretty good handle on things. But going back to the technology space is just so attractive because first of all, it's kind of cool to study, but second of all, the economics of the businesses are better than the average business. And you can find really high return on capital businesses in internet software, in cloud, even in the hardware space, which is, people are sort of afraid of some of the hardware companies, but a lot of them are operating fairly consolidated. That space is consolidated a lot over a lot of years, and it's pretty attractive and still trades at pretty decent valuations. There's also technological competence and difficulty can be a moat, I think, in this day and age. It's sort of it can be a bit of a scarce resource. And obviously the society is leaning much more on digitization and technology tools, and just a lot of the economics is just flowing that way. You can't just pick any company, and we're valuation sensitive, so we've missed out on some of these crazy high flyers, but we're still, I feel like you can be pretty defensive and still outperform as we've done the last couple of years. So we've achieved pretty good performance the last couple of years without participating in some of what some might call bubbles, what I would say is very expensive growth stocks. So that's more, I think we've achieved our returns taking a little bit less risk of big drawdowns than some others.
I really want to get into I want to get into 5G and tech during this interview. So I'm going to start off by asking you, 5G is still in its early stages. It's not in the norm. So, what is a reasonable time horizon for 5G to play out and sort of become the norm that we live in today?
Well, I think 4G began, 2009, 2010. So
for another decade or so?
Another decade. And you probably won't see a lot of the killer 5G apps for a few years. It's very difficult technology to roll out. And then once it's rolled out, there's an open debate about how much it's going to open up over fiber. But even though I say the end result of 5G is somewhat up for debate, all the companies competing in that space are competing very vigorously. So we've invested in a bunch of companies that you could say are sort of the picks and shovels to get 5G up and going. And those are, you can see it in a lot of the semiconductor stocks have taken off despite the economy being in recession during the pandemic, because everyone's racing to get their 5G networks up and to get the 5G phone out with the most DRAM and storage, best features. So, we're very defensive. We're not trying to necessarily pick the winner, although in certain cases where we have confidence, we see a company with an advantage, we'll try to pick a winner. But a lot of the picks and shovels should benefit from over the next 5 to 10 years.
And you've said the iPhone 12 is sort of the first step in a decade-long journey. So now, as this decade progresses, what all are we, going to see throughout this decade in terms of industries and companies sort of propping up to take advantage of 5G?
Sure. Well, there's enterprise 5G and there's consumer 5G. So enterprise 5G, you could see smart factories, private super fast networks where companies can operate machines in factories with no latency. So just much more automation of physical manual processes that'll open up. In terms of consumer, it's hard to know. People talk a lot about augmented reality and virtual reality, connected cars, certainly. But there's probably going to be some things we can't even think of today. 4G opened up the Ubers and Lyfts of the world, which probably didn't envision back in 2010.
Right.
When the founders did, but consumers didn't. People are just going to be downloading entire movies to their phones in half a second. You'll just be able to have so many things at your fingertips. And it's just going to become a new expectation, table stakes for new electronic devices going forward. So I don't know. I'm not smart enough to know exactly everything that's going to happen with 5G. I just know that companies and countries are competing like mad to get their 5G networks up and running. And it could also be a broadband replacement in certain parts of the country, especially where there's there are not really a lot of good wired options. I think in rural and suburban areas, 5G can replace wired broadband. That's already starting to happen a bit, and that'll just take shape over the next few years. Really, it's a lot of the older, not older, but existing tech companies that are just going to get a renewed boost from all these upgrades, I think. So we try to pick those that do at reasonable prices.
Right. Yeah, absolutely. And as you said, that there is especially in something like technology, there is like no way to tell what's going to happen in 10 years from now. Like, in 2005, no one could have guessed an Uber or Lyft that's coming. And one of the stocks you're long is T-Mobile. So, and you believe that T-Mobile is the best equipped telecom firm in the U.S. to exploit the 5G boom. So, how so? Could you give us sort of the story behind T-Mobile?
Yeah, T-Mobile's Stone Oak's philosophy, and full disclosure, we are long. So do your own due diligence,
right,
listeners out there. So at Stone Oak, we look at. I don't like to just delineate between value and growth. I mean, every good investment is a value investment. We like to call it special companies, special situations. And we feel right now that T-Mobile is a special company inside of a special situation. And it has recession-resistant characteristics. So we feel really good about the risk-reward here. So T-Mobile was, I guess, IPO'd back in 2013. It was spun out of Deutsche Telekom. And since then, it was the lagging network behind Verizon and AT&T. So not as good of a network. But what the old CEO, John Legere, did, which was brilliant, was label it the uncarrier. And they offered lower cost wireless plans, and they just took a lot of the customer pain points out of.
What do you mean by uncarrier?
Well, they labeled themselves the uncarrier. And they basically said that the current wireless duopoly between Verizon and AT&T, they bilk their customers, they overcharge them, there's hidden fees. We're going to offer you an affordable plan, and we're going to be much more customer friendly. And T-Mobile's done a really good job over the last decade winning, I guess you could say, the lower end and taking subscribers away from the top two. And they've used that to invest heavily in their network, to where the last few years, their network's gotten pretty much almost on par with Verizon and AT&T in 4G. And they had, in general, they have a lower cost monthly wireless plan than the others. They can do that because they don't pay a dividend. The others do have hefty payouts. and they're going for trying to steal market share rather than optimizing profits. What happened is that in April they closed on a transformative acquisition of Sprint, which was the fourth place carrier. So you basically had four major carriers in an oligopoly going to three players. So Sprint not only was important because it brought along a whole bunch of customers and you can get typical merger synergies and cost savings. Sprint also had a lot of valuable wireless spectrum that was unused in the mid-band range. And that spectrum is going to be really valuable for 5G.
So could you explain to our listeners what exactly you mean by a wireless spectrum?
Sure. So the signal on your phone comes over the airwaves across a wireless spectrum. And there's different, think of different bands of spectrum as different highways. And there's a different speed limit for each highway. There's a different bands of spectrum can go certain distances, so the highway goes a certain distance with a certain speed. So just basically capacity, you could think of it. And that capacity allows certain speed. So when you combine T-Mobile with Sprint, they combined have way more available spectrum for 5G deployments than Verizon or AT&T. So now you're in a situation where T-Mobile, which was the lowest cost wireless plan, is now racing to get ahead of Verizon and AT&T to have the best 5G network, whereas they were the worst 4G network. So in this once in a decade technological transition, you have a great company. And if you look at T-Mobile's returns even before this, they way outperformed AT&T and Verizon. So you have an already really well-run company with a great culture who now will have a new technological advantage they hadn't had before. So that's a very special situation. Now, they're in the middle of trying to execute it. And we think it's a good bet that it'll work. Their last two earnings calls since the merger, they've outperformed. And we think it's just, par for the course. And the thing about T-Mobile is, they don't pay out a dividend. So they can invest all of their capital into taking the lead and having the best 5G network, whereas Verizon, AT&T, they have to pay out billions of dollars every year in dividends, which dividend investors like, but that's still billions leaving the business every year. Whereas T-Mobile can just put its pedal to the metal and try to race ahead. And this fall, T-Mobile is also rolling out a rural broadband offering. So it's now trying to offer wireless broadband to the home as an additional product in rural areas. So that seems to be, if that works, that's a whole bunch of upside that I don't think is necessarily priced into the stock right now. But the stock has had a good run recently, so but I think as 5G kind of takes shape over the next few years, it's going to continue to be a good stock. And obviously, if the economy goes back into a double-dip recession, the last thing people are going to get rid of is their wireless phone plans.
Right.
And T-Mobile is still has pledged to keep its sort of low-cost, disruptive culture, even in 5G. So you could have a situation where you have the best network and the lowest monthly wireless plan, which just from a strategy, it's in a very good strategic position. So we feel pretty good about it.
Do you think that when you think about T-Mobile, you think about a telecom, sort of a slow, boring utility company, and what is it going to take to make T-Mobile sort of get valued as a 5G futuristic kind of company?
Well, it's up a lot this year. I think the stock's up it was up 21% in November. I think it's up 40 or something percent for the year. So that's on par with Microsoft and Amazon. But is it going to go up, 10x like Zoom video in a short amount of time? No, it's not. It's not going to. Could it deliver above market returns while having pretty good defensive characteristics over the next few years? Yeah, I think it could. Yeah. Sometimes you just need to be patient with your investments.
Right.
You're not gonna. This has been a peculiar time. I know you probably have a lot of young listeners, but this is a very peculiar time where some very in vogue stocks have gone up 5, 6, 7, 10x within a year. That's not normal. And you could debate
that comes to mind,
and you could also debate whether it's warranted or not. Yeah, exactly. Tesla's obviously not trading on current fundamentals. I wouldn't short it. I'm not long Tesla. It's been fun to watch from the sidelines.
Definitely, yeah.
There are certain stocks where investors are paying for a perfect scenario for the next 10 years.
Like Tesla.
So if anything goes wrong in that time, or if interest rates go up, something, you could get a big drawdown. Whereas a company like T-Mobile will probably just grind higher over time, assuming that we're right about our thesis. But you never know. I mean, if their broadband offering catches on quicker than expected, people could, stock market is not predictable, even for the professionals in the short term.
So sort of to summarize the T-Mobile thesis. So T-Mobile was this low-cost carrier. Sprint had all the cool stuff, and then when you combine the low-cost carrier and all the cool stuff, you get the cool stuff for a low cost.
Cool stuff. That's a good way to put it. Yeah, it's just 5G capacity. So it's a interesting stock, I would say. And Warren Buffett's Berkshire Hathaway took a stake in T-Mobile last quarter.
Right.
Not that necessarily means anything in particular. They've been wrong before, but they do look for competitively advantaged companies with defensive characteristics, I would say. So
Might have read your letter.
Might have read my recent letter, yes. Who knows? I did write to Warren Buffett once recommending a stock, and he actually wrote me back.
Wow.
He wrote me back within the week.
Okay, did you frame it?
I have it in a drawer. He didn't go for the idea, but he thanked me for it and said it was too hard for him to figure out because it was a technology stock. But
Got it.
I wasn't expecting to get any response back at all.
You'll probably sell that for $1 million on eBay. Well, you wouldn't.
Maybe in 50 years, yeah.
The other stock that you're very big on is Micron Technology, and if I'm not wrong, David Tepper of Appaloosa is also long Micron. I know it's nice to have such a big investor sort of confirm your thesis. I know it's exciting because it's a big player in 5G. So what is it that makes MU or Micron superior to other semiconductor companies?
That's a great question. Micron is interesting in that it makes a commodity-like product. So it makes DRAM memory and NAND flash, and it has a new type of memory it's working on, which called 3D XPoint, which hasn't really been commercialized yet. Likely what David Tepper is saying is the same thing as I'm seeing, is that as you get 5G, as you get artificial intelligence, as you get self-driving cars, the demand for memory, which is basically like the horsepower of all computing, is going to go up over time. And the need for storage is going to go up over time because it's the data revolution, it's digitization, the growing at an exponential growth rate. However, memory is very commodity-like. So the price at which Micron and its peers can sell at is sort of dependent on supply and demand. Why Micron is attractive is that it's one of only 3 companies in the world. There are some others, but 3 companies basically control over 90% of DRAM.
So what is DRAM? Could you explain that?
So dynamic random access memory, it's memory that works while the device is on.
So is there like a difference between like regular RAM and DRAM?
No, that's what it is pretty much.
Okay.
There's different types of it. There's RAM for laptops, RAM for phones, RAM for gaming, but it's all random access memory. So it's fast memory that shoots data fast to applications, but it doesn't hold data when the device is turned off. So for memory that holds data when the device is turned off, that's NAND flash and hard disk drives, which Micron doesn't make. So basically data storage and data transmission.
Right.
So the faster you want data to move, the more RAM you need. So 5G phones coming out now, it's going to have as much as twice the amount of DRAM per unit that 4G phones had. So if you think about it, so even if phone units don't, even if phone units don't grow, you're still going to get a doubling of DRAM demand in mobile over time. Now, if there are hundreds of suppliers and they're all racing to grab as much market share, they're going to make too much DRAM even though demand is going up. But if there's only 3 players, they can control their supply so that they can sell DRAM profitably. And since it's a tough business and it's very capital intensive, there's high barriers to entry. Micron, and so typically you have cycles where they boom and they bust, and they boom and they bust.
And semiconductors are sort of notorious for their cycles.
Yes. But now, and so the cyclical nature of it has made investors wary of the stock. So the stock is traded, or up until a couple months ago, traded very cheaply. It was trading, I don't know, 1.5 times book value. Earnings kind of fluctuate year to year, but Micron earned maybe $2.50 last year, but it earned as much as $12 in 2018. And the stock was in the 30s and 40s until recently it just shot up into the 70s. The stock was also held down, I think, by the trade war with China. The trade war wreaked all sorts of havoc on people. Micron's customers pulled back on buying memory because they were cautious, and then Micron got cut off from selling to Huawei this summer. It was just a huge mess. So hopefully the incoming administration takes a more rational, approach to dealing with China, and things will settle out. But even though the business is cyclical, goes up like that, it should make higher highs and higher lows over time. So we got in one of the lows, and the stock seems primed for an upswing next year. I mean, the stock has gone up about 50% in the last couple of months, so it's anticipating that. But it's still relatively cheap compared to some other high-flying chip stocks.
Could you
And
tell us like why Micron is sort of better than the other two competitors? So you've said that there are three companies who make these DRAM
right.
chips. So could you name the other two companies?
Yeah, the others are Samsung and SK Hynix, and they're both Korean companies, which are harder to trade. So Micron's the only U.S. firm that trades. I wouldn't say Micron is necessarily better. Samsung is more of a diverse conglomerate. So, they've got their phones, they've got appliances, they've got a whole bunch of other stuff. So
it's hard to make like a direct bet on 5G with that.
Yeah, it's not a direct bet on memory. Also, Micron, again, this is similar to T-Mobile. It was sort of in third place in terms of their cost structure. But their new CEO, Sanjay Mehrotra, took over in 2017, I think. And he's been really good. Micron's been catching up to Samsung and SK Hynix in terms of their technology. And actually, so they've been lowering the cost gap between what they can produce a bit for and what the others can produce a bit for over a few years. And it looks like they just actually surpassed them in NAND flash. NAND flash has like 5 or 6 players. But that's also consolidating because Intel just sold its NAND flash unit to SK Hynix. So you're going to go from 6 players to 5 players. So hopefully NAND flash has been more competitive and harder to make money, but hopefully that'll become more profitable. But Micron just unveiled a 176-layer NAND flash bit, which is best in the industry, just in October, I think. So they're really progressing with their technology, and
It's awesome.
yeah, it's a pretty interesting. But a lot of if you have only a few players in a certain industry, you don't necessarily need to be better than your competitors. But if you're as good, an oligopoly should be able to mint profits in theory.
Right.
Without too much competition. Like imagine if there was only 3 oil companies in the whole world.
You'd want to be along all 3.
Probably. The demand picture for memory is probably better than the long-term demand picture for oil.
Sure. Yeah.
That's the theory anyway. It's been hard to hold this stock for 2 years, but it finally is breaking out. It looks like. And that's pretty much the theory.
Right. If you ask Warren Buffett about sort of the mode of Coca-Cola, he's probably going to say it's the brand and it's the fact that Coca-Cola, even if they raise their prices by 10 cents tomorrow, they're not going to lose too much demand. So similarly, for a 5G company, what are the modes needed? You mentioned one, which was sort of the something being highly capital intensive, which leads to high barriers to entry, like Micron. So what are the other modes that you see in this space, and that 5G companies need to be successful over the next decade?
Right. This is probably why Buffett stayed clear of these companies. With technology, a lot of the hardware, well, you can have proprietary technology, which is one way, which is something that, say, NVIDIA has, as an example. Very expensive stock, but if you have the best chip, you can probably charge a premium for it. But with something like Micron or T-Mobile, it's about efficiency and being the low-cost provider. So if you have a lower cost than your competitors, you can sell for less and take market share, or you can sell for the same amount and make bigger profits. So that would be something like, like Geico, which Warren Buffett. So that's a low-cost provider that has structurally lower costs than competition. So that's another type of moat. And then you have a combination of technology and low-cost provider, which is what T-Mobile is right now, which I like very much. Another powerful technology competitive advantage is network effects, which is not necessarily 5G, but A lot of online marketplaces have that. Social networks have that, where you get a critical mass of users, and then other users flock there because
There
there's
are more
already users
users.
there, and then
That's become sort of self-reinforcing, and
that's a very important one in these internet and software companies.
right, like
Which is why
Facebook and
first movers like Amazon and Alibaba are so can seemingly grow every year, despite their enormous size. But yeah, so technology is, I would say, less about pricing power, usually, and more about network effects and lowering costs and just certain technology advantages that you might have.
Could you describe your overall process to identify, the stocks that you're going to buy? Sort of from how you generate ideas to how you decide to, making the decision to actually purchase the stock and what all goes in the middle.
That's a great question.
We're going to learn Stony Oak's secret sauce.
There's no one particular way. Obviously, I write investment articles as well. So if I'm always reading and researching new companies, just a lot of it's just perspiration and just reading annual reports. Pick up an annual report of a company you don't know. Or if you're interested in one stock in the space, learn all of the companies in the same industry. Eventually, over time, knowledge will compound. If you just learn a little bit more each new day. So a lot of it's just plain old reading and following technology trends, following companies, following industries. I do some quantitative screening. So there's certain, you can pay a lot and have expensive screening software. I think there's some free screening internet tools as well. Like I think Finviz is one. Yeah, I use Finviz. If you know what you're screening for, it's a good starting point. Obviously, you have to then look deeper into the story. But really, you'll come across something that's either interesting from a growth perspective or a value perspective, and then you dig in. You can learn a lot really from the annual reports and quarterly reports and conference calls. And if you go back and read the last annual report, the last quarterly report, last few conference calls, and you read about all its competitors, and you learn about the industry, maybe you can get a pretty good idea of whether something's a good investment. If we need a question answered, well, I'll try to do some research. We talk to former employees, talk to some customers. That's really if I'm looking for a specific answer to a question. We're a small shop. I'm only one guy. I have an intern. It's me and an intern, so there's only a limit to what we can do. But sort of double checking on if customers really love the product.
Right.
And you can find out a lot in online forums too. If customers love the product.
You could just find reviews online. You could just search up, T-Mobile carrier reviews and, what it's like.
Exactly. But a lot of it's there, There's so much information out there in public. So between screening, reading a ton, and doing some interviews when we need to, we can get a good idea. And then, sometimes the market just gives you stuff and just sells off stuff for like no reason.
I wouldn't say March was no reason.
Yeah, March was definitely a reason.
At least you can find a reason to justify every sell-off. At least
Absolutely.
CNBC does.
Now, it was definitely a good reason, but you could say, did the market overshoot? Like it probably overshot to the downside.
Probably did, yeah.
And then once the stimulus passed, certainly that gave people some confidence. But no, it was a very uncertain time. I'm not going to pretend that we played that perfectly. We didn't. We didn't at all. I mean, we're still up. We're still beating the market for the year. But, you know, I guess the more experience you get, though, the more confident you'll have that you try to step back and keep a cool head in situations like that. You know, any business is worth the present value of all future cash flows.
That's
So
true.
step back and say, it's okay, 2020 is a wash. So how does that affect the value? Maybe it affects the value by 5%, 10%. The stock's down 40 or 50%. You need to have the confidence to step in and, buy when others are selling. In order to outperform, you kind of have to have a differentiated point of view, maybe, and you have to be right. So it's difficult.
And the other thing that I wanted to ask you is, since you're a tech investor, in I believe your last letter, you said that you still feel comfortable owning expensive stocks. So, do price multiples ever impact your thesis? Because if you look at most tech companies, their price multiples, for example, P/E ratio is usually around, say, 50 to 100. And you've got companies like Tesla, which are over 1,000. So, do you ever do like price multiples ever impact your thesis and your thinking?
Price to earnings multiples aren't valuation. It's a snapshot. It's a shortcut to get to valuation. Again, a company's value is the present value of all future cash flows.
That is true.
So a P/E ratio is a snapshot of what its earnings are today. So we'll invest in a company with a low P/E ratio. We'll invest in a company with no earnings today whatsoever if it's growing fast enough. I always come up with some sort of number, which is a best guess of what intrinsic value is.
Just try and make it as conservative as possible.
Try to make it conservative as possible, although if you're too conservative, you might miss out on, if a stock is early enough and you like the management enough and the total addressable market is big enough, you don't necessarily want to wait. You could miss out, is what I'm saying. But we don't go chasing stuff we think is overvalued. A great company at a reasonable price, you can make a lot of money on as well. It just has to be reasonable. And it was interesting. You mentioned a lot of tech stocks, and you also mentioned Tesla. So the reason why, Tesla is kind of crazy because it's right now it's a car company.
It's getting valued like a software company.
Yeah, it's going to have to build these very expensive plants. It sells a piece of machinery at a 20% gross margin. It's not making an 80% gross margin.
Right.
And investing which has to invest no capital except for sales and R&D.
Exactly.
So obviously the market is anticipating Tesla is going to change the game beyond merely selling cars. And they might be right, but you're also paying for that today. Whereas you get something like Amazon, it's got Amazon Web Services, which is very efficient business. I mean, well, they have to build out data centers too, but some sort of software company that really doesn't have a lot of capital expenditures and is growing at a high rate and reinvesting all back into sales, that's a little bit different. That's where I'd highly recommend, if people are interested in valuation, to look up Aswat Damodaran's website, my professor. He puts a lot of material out there for free.
Right. And he's got two.
You can essentially take a class
website, yeah,
without going to NYU.
He's incredible.
He's got model templates that I still use for my valuations. And that's a great place to look. And his blog is pretty funny too. He likes to delve into a lot of the hot companies out and see what they're actually worth. Not that he's always right in his analysis, but the principles and the tools he uses are helpful.
You also sort of agree that EVs look very dangerous because these are car companies that are being valued like software companies. So would you agree with people who say that FANG stocks are specifically are in a bubble right now? Because number one, we've sort of seen retail speculation go to new heights, and Warren Buffett has warned against being or getting into euphoric markets. So do you think these are signs of euphoric markets? And also, as a tech investor, I wanted to get your thoughts on the sort of extreme concentration of technology stocks in the S&P 500, because there's 11 sectors, and tech, which is one single sector, is worth, I believe, about a quarter of the index.
Yeah, well, it's a great question. I actually think the FANG stocks, with the possible exception of Netflix, are reasonably valued today. If you look at the large cap tech stocks you're referring to and their revenues and earnings and growth, it's not even close to what people are paying for these EV stocks or even some smaller software companies that, a lot of these smaller software companies are priced as if they're going to become the next Amazon or Google. But they're far small. They're way early in their growth stage. With the exception of Netflix, which is, it's a, not that Netflix is Netflix is a great company, but it operates in a specific niche. The other companies you talked about are all essentially diversified industrial conglomerates with a tech basis. And again, they are benefiting from those powerful network effects since they were first and they have a first mover advantage. And they just, we have a multi-year lead. The markets they're in are still growing, and they have the capital to invest in new products and other companies. So they're very hard to stop. The thing that could stop them, I guess, is the government coming in and breaking them up.
The 48 states today filed an antitrust lawsuit against Facebook, so that was interesting.
Yeah, that's a whole other topic, but it's going to be difficult to prosecute that, but who knows what will happen. But in general, that those companies are actually putting up the results to back up their valuation. So it's no surprise that Amazon's gaining as brick and mortar retailers, for the most part, are falling. And the nature of the internet is that you get these network effects and you get these giant winner-take-all markets. But people are always looking for the next one of them, and they're bidding up every single IPO that's coming to market as if it's going to do. Look at what DoorDash just came
today.
DoorDash's valuation is like quintupled since like February in this private funding round. Or look at Snowflake. Snowflake's a great company, by the way, and I think it has competitive advantages, but its valuation is, totally off the charts. It actually makes the FANG stocks look cheap by comparison, is what I'm saying.
What you're saying is long FANG stock, short the IPOs.
I would not recommend going short the IPOs because, well, when you're short a stock, you have unlimited losses.
Right.
Let's just put it that way. So be very careful about that. And bubbles can go higher than longer than you can stay solvent. So
right, that is true. We've had Tesla to prove that.
How many fundamental short sellers has Tesla wiped out?
Probably all of them, to be honest.
In the last few years. What I look for is stuff that I can go long at good prices. And even in today's market, it's my job, and I have the time to go look at special situations and special companies and transitions that are happening in industries and try to get long asymmetric opportunities, which is probably going to be more important in 2021 since the market has boomed back to normal levels after the pandemic. I think the FANG stocks have largely earned especially in a world of zero interest rates, they're not too demanding at all. With the possible exception of Netflix, just because I'm a little bit worried about all the competition that's coming in. I don't know if that answered your question. But again, our world is more dependent on technology. It's natural that technology gets more
weightage,
gets more of the economic pie.
To wrap up the podcast, I wanted to ask you, what are your top 3 tips for investors, or your top 3 words of advice for investors today?
Sure. For beginning investors?
Just in general.
Just in general. First of all is know the company behind the stock. With Robinhood, it's easier than ever just to look at the stock as a ticker and the numbers going up or down every day, like it's a sports bet. It's a company, and it earns revenues and profits and has a balance sheet. Understand what's behind the name, because markets can move up or down a lot in a short amount of time without any warning. So you have to have confidence, know the business behind what you own. What else? I would say be wary of hopping on something just because everybody else is hopping on it. Study the 1999 tech boom and bust. If you don't know that history, not that things are that bad today, but they're getting a little bit frothy in certain sectors of the market. And I would say you have to really enjoy learning about companies and economics. If you don't really enjoy the learning part and you're just doing this, like you're betting on a football game, better off maybe investing in an index or having a manager like me manage your money for you. You have to enjoy the game rather than the result, I would say.
So to summarize it up, first you said know the company behind the stock, and the second is study the .com bubble and study history in general so that you understand how bubbles work. And then last, you said you got to enjoy the game and shouldn't be in the game just for the money. So yeah, thank you so much for being on the podcast.
Thank you, Sri. This was great.